Hello, everyone. Welcome back to Investing Sucks. My name is Eric, and thank you so much for tuning in. So today I'm going to be doing another video on BAM, Brookfield Asset Management. Now, I made a video a while back talking about this company and talking about why I think they're one of the best stocks really on the entire TSX. Now, best isn't a very descriptive term because that can mean a lot of different things when you're talking about companies. Really, what I wanted to show in that video was all the great qualities and the unique qualities this company has, and also talk about why I personally own this company. So it's only been about 6 or 7 months since I made that video, and I want to do an updated analysis on them a year after I made that video to kind of do a year in review and compare what I projected in that video versus what actually happened, because you really can't do that sort of analysis unless at least a year has passed. So the reason I'm covering them now is because there was news that came out recently where they're potentially thinking of spinning out their asset management business. And it was a pretty interesting move. And there's a lot of interesting strategy here. And I wanted to kind of talk about it for a bit. So for those who aren't familiar with Brookfield, you probably are aware at least that they're rather complex and they're a very unique company because there's a very unique combination of businesses that you get when you buy shares of them. So to keep things simple, you get two main businesses, which they call asset management, which is a business that generates fees on the funds that they manage on behalf of their investors. So it's fixed fees, usually depending on however many assets under management they have, or what they call fee-bearing capital. And then there's also the other business, invested capital, which is a portfolio of assets that the company owns itself and not through any separate funds. So it's complicated because there's a lot going on. There's a lot of different businesses that you need to value separately, and that can be difficult because it means you have to read disclosures and all the supplemental information that they provide and really kind of deduce down what sort of value to place on the individual businesses. And they, in addition to that, they also earn carried interest, which is an extremely volatile form of compensation that depends on whether they had hit certain return targets or not. So it can either be extremely high if they do well, or it could literally be zero. And investors tend to not like complexity. It's better to keep things simple. So what management is thinking of doing here is they're proposing a spinoff where they separate out the asset management part of the business from the rest of Brookfield and make it a separate company with separate shares that you can buy on the stock market. And that way it would make Brookfield a bit easier to understand. So if we take a look here at the actual earnings call transcript from their most recent Q4 earnings call, we can see what their reason for this was. So they're saying that their asset management business is now of the scale that it can be separated out from the rest of their capital, so the invested capital part. And we're currently in a market environment, or they believe, where the market prefers asset light managers. So it may make more sense to separate out part of the manager and offer investors a security that owns the asset manager separate from the capital, which would be all, those real assets that they own. And then down here, they even go so far as to say that based on comparable multiples, which we'll get into what that could mean in a bit, of pure play asset light alternative investment managers, they're typically valued in the range of 70, I think that should say 70 million or a billion rather, to 100 billion. And that's in addition to the 50 billion in net capital that they have invested in the business. So they're basically saying that based on those multiples, Brookfield, as it is right now, could be worth as high as 150 billion. And we compare that to what it is right now, and it's only about 100 billion. And this is in Canadian dollars. I believe in their transcript they're referring to US dollars because that is what they report in. So they basically believe that if they spin out the asset management side of their business, it will add shareholder value because of, number one, the market's preference for asset light, high margin businesses, and because it would make the business as a whole less convoluted and more easy to analyze. Now, the whole concept of companies spinning out parts of their businesses as a way of adding value is not something new. And it's something that I'm going to call the holding company effect. That's not an official name for it. That's just what I personally call it. But what I've found on rare occasions in the stock market is that holding companies that own multiple businesses will sometimes have the total value of their company be less than if they were to separate out all of the businesses that they own. And this isn't always the case, but you do tend to see it happen sometimes. So the question is, why is that? I mean, they're all the same businesses. What's the difference between if they're just separately listed entity versus combined into one company? Well, the best way I ever heard this get explained to me was to think of it as if you're buying artwork and say you really want to buy a painting by Pablo Picasso. But the only option for you to buy a painting from Pablo Picasso is to also buy a bundle which comes with a Salvador Dali painting. But you're not as interested in the Salvador Dali painting. You just want the Picasso. So you don't value the cumulative total quite as high as if you were to be able to buy those paintings individually. Because if you could buy them individually and say they went up for auction, then the only people who would be looking to buy the Picasso were people who just want the Picasso. So it's going to sell to the highest bidder. And then for the Dali painting, it's the same thing. That's going to sell to whoever the highest bidder is, which is presumably going to be someone who just wants to own the Dali painting. But if they're being sold together, then you need to find someone who wants to own a Picasso and a Dali painting, which becomes less likely, especially as you add more and more paintings, which we can substitute for businesses in the real world, because then you need to find someone who's interested in buying all of those. Whereas if they're just individual companies, then the people who are buying them are just interested in owning that one individual company rather than the whole bundle. So that's kind of why you tend to see the cumulative value in some cases be less. And also because it just tends to be more convoluted. It's more difficult to analyze. So we can apply this to Brookfield because maybe some investors really just want to own the asset light, high margin asset management business and not so much the invested capital portion, which includes over 100 US malls and all these other real assets, which they're not as familiar with, and it's more difficult to analyze. Now, that's just really speculation on my end. Obviously, I don't know what all the investors out there are thinking, and it's possible that this is really just PR from Brookfield as a way of just elegantly raising the stock price in the short term or to get investors excited about the company's future. And Brookfield does have a pretty good knack for PR. They've done this in the past. And PR can be important for public companies because it obviously does influence their stock prices. And so speaking of stock prices, let's actually look at what the market's reaction to this news was. So it came out around February 10th, and we can see there was an initial slight spike in their stock price at that time. It went up to $76 Canadian. But since then, basically all those gains have been erased as it's kind of fell with the broader market. So, and remember what they were saying before was the company could be about $150 billion in value in USD, based on what they referred to as comparable multiples. So it clearly seems like the market isn't taking management's word for it, and they're not really reacting to news of this spinoff just of yet. And I also think it's true that Brookfield management themselves probably don't even believe those numbers, because if they did believe those numbers, then they would be basically spending all the cash they have to buy back their own stock, because they're basically saying that they think that their stock is undervalued by 40 or 30%. And I guess we'll see if that actually takes place in the next quarterly filing, but I highly doubt that they've been buying back massive stock. So really, I think it's just conversation on their part. So I decided to go into Excel here and do some basic calculations on what multiples they're referring to when they say comparable multiples, because that's really what their justification is for this spin out, creating additional shareholder value. So I pulled in two competitors here, so Blackstone and BlackRock. These are both very large asset managers. They're not really alternative asset managers like Brookfield, because they do offer very basic ETFs that a lot of people invest in, especially in the case of BlackRock. But at the end of the day, they're both competing for investors' capital. So I think they're competitors in my book. And just using a very basic multiple, like a PE multiple, which I doubt this is the actual multiple they're referring to in their earnings call transcript, but let's just apply it anyways and see what type of value we can get on the asset management side of their business. So the PE for Blackstone is about 15, and for BlackRock, it's just under 19. Now, multiples are obviously going to be dependent on investors' perceptions of how fast the business is growing. So a good metric to use to measure that for asset managers is how much assets do they have under management, or AUM. So in the past 5 years, Blackstone's been growing at about 12% a year, their asset management or their assets under management. BlackRock just under 10%, but Brookfield has been much higher, 25%. So I think it does make sense to be okay with giving them a higher multiple. Now, keep in mind before we go any further that they've also said in their earnings call transcript that they think that invested capital is around $30 a share USD, and their current share price in USD is 53. So about 23, what Brookfield management is telling us, $23 can be assigned to asset management. So if we take their earnings for the asset management division alone, which was 2.6 billion, we apply the Blackstone or the BlackRock price to earnings multiple, we get an additional value per share of 31. But if we apply the Blackstone PE multiple, we get 25. So that would essentially mean that if they did this spin out, it would add shareholder value as long as you believe that invested capital is valued at around 30, because then this would be this plus 30. So it would be 61. And then this one would be slightly higher. So, I mean, it creates a bit of value, nothing significant there. However, what you really have to use to value Brookfield's asset management business is what they call FFO, or operating FFO. This is much more indicative. And because their assets under management is growing much faster than Blackstone and BlackRock, as we can see here, I do think it makes sense to apply a higher multiple and apply that multiple to the asset management FFO, which is funds from operations essentially, because that takes into account, I've done the calculation down here, fee-related earnings plus realized carried interest. So I took what it was in Q3, because that's Q3 of the most recent year, and then multiplied it by 4 to get an annualized figure. So it's kind of a more up-to-date figure. So then we get 2.3 or 2.4 billion. So say we apply a 25 multiple to that, then the value per share of just asset management is 38. Now, remember, the range they gave was 45 to 60. So if we want to take the lower end of the range, they're basically saying they're applying a 30 multiple to asset management FFO, which I think when they refer to multiples, they're probably referring to asset management FFO, because that is what they always tell investors to use to value their business. So I would assume they're using it here as well. So on the lower range, they're using a 30 multiple, and on the higher end of the range, they're using about a 40 multiple. Now, 40 multiple is quite high, but Brookfield is growing fast. So these two multiples, I think they do make sense. However, it really just depends on if this move were to actually materialize, because a lot of this right now just seems like conversation, and it all depends on how the market would actually react if they did end up doing this move. So if you believe these numbers that I've put here and this makes sense to you, then you may be thinking, well, I guess there's an opportunity to earn some sort of short-term gain on Brookfield. But remember, this is just, like I've said many times now, it's just conversation. They actually haven't initiated any formal plans to do this yet, which they have to do, because they could always just axe the plans later. And then if the only reason you bought the stock was in anticipation of the spin out and it doesn't happen, then you're kind of left holding the bag. So that's pretty much my thoughts on this. Just kind of wanted to do a shorter video explaining, one way that I look at these things and how you can kind of play around with numbers to get a general sense of, what management is thinking, which I think if you are invested in a company for the long term, you're going to learn a lot about their management and how they like to think and make decisions. So it's good to do this type of analysis. So I hope you guys did find this useful. If you did, then please leave a like and subscribe if you're new to the channel, and I'll see you in the next video.